Greetings from Geojit Financial Services. We are on to another IPO heavy week, and the latest to hit the markets is UTI Asset Management Company, which is open from September 29th to October 1st. This can be considered more as an offer for sale by its existing promoters, which include SBI, LIC, PNB, Bank of Baroda, and T. Rowe Price. Looking at its business, UTI AMC manages domestic mutual funds, acts as PMS fund managers for clients including state-run funds such as EPFO, ESIC, Postal Insurance and NPS. It also manages offshore funds and alternative investment funds. There are a lot of variables that you need to consider before deciding whether to invest in this IPO or not. Let us look at the positives of this company. It is the second largest AMC in terms of total average assets under management in India. It is the 8th largest AMC in terms of mutual fund quarterly average assets under management. It accounts for around 12% of the total mutual fund folios in India. It is also the second largest PMS fund manager after SBI, with clients including, as I mentioned earlier, ESIC, EPFO and NPS. The inflows from these clients is more or less guaranteed because the Government of India is an indirect shareholder for UTI AMC. The second positive is with regards to the potential that is there in the mutual fund industry. The current industry is underpenetrated, and with increasing financialization of savings, the active capital markets, the participation of the salaried class as well as regions outside the metros and the top cities will only increase in the future. In fact, the growth in B30 cities have shown a consistent increase. And this is where UTI AMC scores well above its peers. UTI AMC has around 24% market share in B30 category of cities, which is the highest when compared to the other larger AMCs. The retirement plans of UTI is also a clear advantage over its peers. Government institutions, government employees and pensioners always look to have good retirement plans, and UTI has a clear advantage in this area. Looking at the concerns for this IPO, the company is dependent on its management fee income, which is again dependent on the AUM, the assets under management for this company. The domestic mutual fund business, the market share, which accounts for around 59% of the total income of this company, has been on a consistent decline over the past few years. The reasons could be many, including in the short term, the COVID-19 related uncertainties, which could have resulted in a lot of outflows from the entire mutual fund industry. The other reason that could have impacted the market share, the domestic mutual fund market share, is because of the relative underperformance of its equity mutual funds. UTI has very few funds which are in the top quartile in the respective mutual fund category. Its 6 active equity funds account for around 75% of its total AUM, which shows fund concentration. So, comparing the positives with the negatives, if it can improve its fund performance, its already established leadership position and pedigree can help the AMC go up the rankings. Let us now look at the financials and the valuations of this IPO. Revenue and profit growth have been declining over the last few fiscal years. However, this could be more due to the SEBI mandated rule to cap the expense ratios than on any real underperformance. The Q1 numbers have come out better, but it is too early to make a judgment call on this. The IPO is currently valued at 25.5 times, which is comparatively much cheaper when compared to its listed peers, HDFC AMC and Nippon India AMC, which are trading at 35 times. But then the one thing that we need to look at is that HDFC AMC has managed to grow its market share, and the market may be paying a premium for that. The return on equity for UTI AMC is also much lower when compared to its listed peers. So although the offer price is good, the valuations are cheaper when compared to its listed peers, but there are other factors also that you need to look into. So summarizing, there are a lot of concerns for this IPO along with the positives. Accordingly, we recommend a subscribe rating on this IPO for the aggressive investor and for those investors who are looking especially at the listing gains. Please note that market momentum is also a key factor, and the investor would do well to look at the overall subscription trend before investing in this IPO. Thank you and happy investing.